All right, good afternoon, everybody. My name is Bobby Rains. This is our once every 3 weeks Investors Observer members only workshop. Let's get started. All right, so our agenda today, we're going to look at a few charts. We're going to talk about what sectors and industries are hot right now in the market. A few quick reactions to the Federal Reserve meeting this afternoon. Talk about what else is happening, and then member-driven content, questions, site demonstrations, that kind of thing. It is up to you. I did get a question ahead of time, so I have a couple slides to answer that, but there should be plenty of time to answer whatever questions it is you may have. All right. And yeah, as always, if you have questions, just put them in the box whenever. I've got two screens here, so I'm monitoring the questions as they come in. I can either interrupt myself or save it to the end if it's not relevant to what I'm talking about immediately. All right, let's go. So yeah, here's the S&P 500. This is the last year. Made a pretty nice recovery since the dip around Christmas time. Leading into Christmas time. Anyway, we're sort of just breaking out today above the mid-November highs that we set here and here. So that's nice and kind of interesting. We'll talk a little bit more about what that means and why that may not necessarily be a positive in the short term a little bit later. Just for reference, especially when we get to the comparison charts, where we have some percentages. We are right at the beginning of February here. So in terms of year-ago performance, we've already knocked off some of this big drop. So we have a lower baseline on some things. When we get to some of the comparison charts, we're not down as much this time from a year ago as we were 3 weeks ago from a year ago. And that's because this piece here has dropped off of our year-ago chart. All right, so back to 1 year on the NASDAQ. Sort of a higher level of new high here, which is interesting, I think, mainly because the NASDAQ was the piece of the major indices that performed worse last year. So for that to be up a little bit more and looking a little bit better this time around is, let's just call it interesting for now. The Russell, even better looking. The Russell wasn't down quite as much as the NASDAQ, I don't think, for 2022, but tends to be smaller stuff, a little more volatile, a little bit riskier sometimes. Not necessarily a sign of tighter financial conditions when the NASDAQ and the Russell are higher. Keeping in mind what the Fed is trying to do in terms of tightening financial conditions. Small caps and tech stocks, having higher valuations is not necessarily what tighter financial conditions means. So to look at the S&P 500 versus the equal weight, the 500 is in the blue here. Still lagging quite a bit, although not lagging as much as it was the last time we looked. Most of that difference is due to that big slide having fallen off the chart. We were down more than 16% on the S&P 500 over the last 12 months last time, and this time it's less than 13%, and it's not because the market is up that far. It's up a little bit, but it's not up, almost 10% since the last time we talked. It's really just a lot of that big drop has fallen off. But yeah, and the reason I like this chart is the big tech stocks have an outsized influence, although it's less outsized now than it was at the beginning of last year. They do have an outsized influence in the S&P 500. And so if you look at the equal weighted index, you can kind of see how all of the stocks are doing as opposed to just how the the biggest stocks are doing. And in this case, the biggest stocks are still lagging a little bit, but this gap has been relatively constant for a while, which means that sort of things are by and large moving up together. All right, growth versus value, still a big gap here, although growth is catching up a little bit. Just if you look at just the steepness of this versus the steepness of this, you see we're getting, value stocks have been moving up here a bit more than the growth stocks. And growth stocks have been moving up more than the value stocks, and that's what you would expect normally. Growth stocks are growth stocks, right? They tend to go up faster than the value stocks. That was not the case in 2022. But it is the case now, anyway. All right, so what sectors and industries are hot right now? Energy, still at the top, although there has been a change there with oil and gas drilling, finally knocking thermal coal off the top. Thermal coal has been at the top for, I don't know, it feels like months and months. And then oil and gas equipment and services. I think that's interesting. Oil prices were down towards the end of last year. They're up a little bit now, but not nearly where they were in the middle of 2022. After the Russia invaded Ukraine, they were pretty high. They've come down and then come back up a little bit now, and so that's good times for oil and gas drillers. Oil and gas equipment and services is another thing that you like to see being up. Drilling activity, with the way fracking works, more drilling activity tends to mean lower prices. But there's a weird thing that happens where prices get too low, then the drillers, don't break even, and so they stop. So there's a kind of sweet spot for the economy where oil prices aren't so high that, consumers are really getting hurt by high gas prices, but they're not so low that the drillers in the U.S. stopped drilling. And so what happened last year was oil had been low coming out of the pandemic, and a lot of the infrastructure was offline. There hadn't been a lot of drilling investment and things like that. And then prices went up really fast before the drillers could really come online. And so this is kind of an interesting dynamic we have here. And thermal coal is slipping a little bit. It's been warmer than expected in Europe this winter and a few things like that. Thermal coal is also a relatively small industry at this point compared to the oil and gas in particular. Utilities remains in second place in terms of our short-term technical score, which is kind of interesting. The positioning of them shuffled around a little bit. We're back to our sort of, these two especially have an interesting relationship, just because, one, energy prices going up is good for energy companies and tends to be less good for utilities that are buyers of energy. Also, energy tends to perform well in a growing economy, whereas utilities tend to be things people buy when they're worried about the economy. So we're still seeing a little bit of that. These stocks also pay a dividend. They're good flight to safety stocks. So people tend to buy them when they're worried about the stock market, in addition to being worried about the economy, which are different things, let's say. Industrials, making a move up the list: airports and air services, engineering and construction, metal fabrication. That's all, again, growing economy stuff. Right, like airports and air services has a lot of like air freight and some things like that in it. Engineering and construction is exactly what it sounds like. Metal fabrication is pretty much what it sounds like. Next, basic materials, coking coals used in making steel, copper, aluminum. Again, more growing economy stuff. I'm not sure how much of this is, those last two really are China reopening, starting to show up in the market for things. And how much of it might be something else. I do think it's at least partially that, but that's, those are the kinds of things you would see demand for in a growing economy. And so to see those stocks performing well suggests that investors are putting money into those sectors. Consumer defensive, remaining on the list but sliding down. Confectioners, food distribution, discount stores. That is more of a, it's right there in the name of the sector, defensive play. Again, the kind of thing people buy when they're worried about the economy. So we're still getting some of this tale of two markets, although I think consumer defensive was in this middle spot the last time, and now it's sliding down. And I think, to me, that's somewhat encouraging for people's outlook about the market and the economy. Economies are, to some degree, largely about confidence. People lose confidence in the economy, they stop spending money, the economy gets bad. So for people to be confident and demonstrating confidence in it seems like a positive. The, I guess, other complicating factor is engineering and construction is the kind of thing that is typically sort of, financed. Not a lot of people are paying cash for their large construction projects. So that's, again, another thing where you might see something that almost looks like it's running a little bit counter to what the Fed is trying to do in terms of tightening financial conditions. You wouldn't expect interest rates to go up and a bunch of people to go out and suddenly try to finance a construction project. So that's interesting. It's something we're kind of keeping our eye on here. This list comes from the website under sector and industry. And then I sort them by the short-term technical score. The short-term technical score looks at the last 20 to 30 days of trading. And so I find for a presentation we do every 3 weeks, it's pretty useful. It also, I think, moves around enough to give you an idea of what's doing well in the market at any given time. All right, so the Fed came out with a statement at 2 p.m. today, and then they had a press conference after it, as they do. They seem to be at least signaling, and I say signaling because they tend to be pretty adamant about not getting put in a box and saying that things can change. We might do something in the future that's different from what we say today, so we don't want to say any guarantees. But right now they're saying they anticipate ongoing increases will be appropriate to attain sufficiently restrictive monetary policy to get inflation back to the 2% target. The things that are interesting to me about that particular quote is ongoing increases. So one, increases suggests more than one. I think a lot of people were expecting today and then perhaps one in March, and then that would be it. Ongoing increases suggests they're not going to pause and then raise rates. They're going to keep, right now at least, plan to keep raising rates. And then, like that sufficiently restrictive monetary policy. They're looking at a lot of, prices for money in markets, whether it's equity markets or bond markets. And so it's interesting, as this came out and Powell was talking about tightening financial conditions more, bonds kind of rallied a little bit. And I didn't see where stocks ended up, but they were up for a while afterwards anyway. Powell also said the labor market remains extremely tight. We have seen some slippage in wage growth, which is a positive as far as inflation goes. But the actual unemployment rate hasn't really moved much. Powell also said it's important that the overall financial conditions reflect what the Fed is trying to do. So again, rising stock prices, falling bond yields, those are loosening financial conditions. So it's a little bit weird that the Fed comes out and says, we're going to tighten financial conditions and we need them to be tighter. And then the market turns around and says, yay, and financial conditions loosen. It's a little bit weird that we've seen this reaction several times now. I'm not 100% sure what to make of it. The obvious takeaway is the market doesn't really believe the Fed, but I have some questions about why. Powell also said, we think we've covered a lot of ground and financial conditions have certainly tightened. We still think there's work to do there. I think that's interesting, right? Rates are up from where they were earlier in the year, earlier this year, and considerably up from where they were, a year ago. But yeah, obviously they still think they have some work to do here. And what I think this sentence was interesting to me because he's talking about the tightness of financial conditions and still having work to do, not talking about still having some work to do on inflation. So I think those things are different, and wanting tighter financial conditions, again, points to more hikes in the future. He also said the terminal rate, which is sort of where they get to when they stop hiking rates, could be higher than the 5 to 5.25 they suggested in the December forecast. Again, could be is doing a lot of work there. Some of this is signaling. I believe today they raised to, I think it was 4.5 to 4.75. So you figure another 25 in March gets you to 4.75 to 5. Maybe one more after that gets you to, right, like where this 5.25 is. So he's saying they could potentially do, more than 2 rates even, but also said not far from the peak. Granted, not far from the peak when you're up basically 500 basis points in the last 12 months is, certainly we would hope we're more than halfway there. I don't think interest rates are going to go to 10%. That would be crazy. But it's hard to know what that means, and it seems a little bit obvious, but I do think he's seeing some reasons for hope, some glimmers there in terms of inflation moving in the direction he wants it to be moving. All right, so what else is going on? Economic data generally has been pretty good. Some softening in things, particularly in the things the Fed is looking at, right? Like that unemployment report. Well, we'll get February's that comes out, or the January report comes out on Friday. But, we've gotten some reports recently where it looks like wages are sort of softening a little bit, but unemployment isn't really rising. That's kind of the Goldilocks scenario. That soft landing that people were convinced, several months ago was impossible, kind of seems like it's in play here in the sense that, if prices are starting to come down in a lot of places. There's some stuff with the way the rent portion of CPI is calculated that we already know is going to come down in the next couple of months. Eggs are one thing that are still particularly high. They're high because of some things particular to the egg market, not because of overall financial conditions. But yeah, generally things there look pretty good. Earnings season has also been pretty good so far. There's some, company-specific problems. But things tend to be mostly positive. Expectations were sort of a little low in the sense of, a lot of people were predicting a recession last quarter. And so, yeah, it's not surprising that they're a little bit low. Big tech is up tonight and tomorrow night. Apple, I think Microsoft, a couple of other big companies are all reporting in there. Those companies tend to be sort of a bigger part of the stock market than they are of the economy. They're still, certainly pretty important to investors and to the economy, but they're a bigger part of the stock market than they are of the economy. And I think it's possible we'll see some continued weakness there. Apple has had iPhone shortages in the last quarter, some things like that. Really, I think what we're going to be looking at is the forward guidance. And even then, Apple in particular, it's harder and harder to, the upgrade cycle has gotten a little bit longer in terms of, the differences to most people between the iPhone, what are they on now, 14? The differences between the 13 and the 14 versus the differences between like the 3 and the 4. are not as big. And so there's less reason to run out and buy a new phone every time a new one comes out. And that obviously cuts into Apple's bottom line if you're, buying a phone every 2 years or 3 years instead of every year. And they're trying to make it up in services and things like that. It'll be interesting to see how that goes. It's also going to be interesting to hear from the Google and some of those companies that are more advertising based, because advertising says a little bit about sort of how the rest of the companies in the economy are feeling. So that'll be interesting also. China reopening, I talked about it a little bit earlier. I think we're going to see more normalization in the economy, hopefully less weird shortages of things. The chip shortage seems to be largely behind us. In fact, we seem to have a few too many of some kinds of chips right now, memory chips and some of the more commoditized pieces especially. The prices for those are falling, so like your Microns and some of the other companies that are big on the memory are kind of struggling right now. But yeah, I think it's important to remember that when I say normalization, I don't think things are necessarily going to go back to where they were in 2019. A lot of people are just working from home now. There's been some slow trickle back, but even then, companies are saying like, "Hey, you need to be in the office 3 days a week," whereas before it was 5. So that's a 40% reduction in time spent in the office. Companies are taking a much harder look at their supply chains and trying to make them either less dependent on China or more robust or both. And the thing that made China so attractive for companies was everything is sort of right there together, right? Somebody famously had a story about, being in one factory and deciding they need a certain kind of screw and just like going across the street to the factory where they made screws and, figuring out exactly what it was they needed there and getting it done that way. That's very, very efficient unless that whole city shuts down, and then nothing's happening. And if all your supply chain has those choke points, then you have problems. But it is very efficient. So I think what we may see going forward is companies willing to sacrifice a little bit of efficiency in order to get that sort of resilience where, maybe you're not quite so dependent on specific countries or specific narrow slices of geography like that, because, those things do have risks and costs. It's just they don't show up necessarily from quarter to quarter. It'll be interesting to see how much efficiency companies are willing to sacrifice as far as that goes. Hang on just a second here. Let me get this chart that seems to have disappeared. Paste it in here. But yeah, we have reached the questions portion. There we go. Sorry about this. I was messing with these charts until shortly before we started today, and somehow this one didn't get popped in correctly. So while I'm working on this, Richard says he keeps missing these sessions, and are they recorded? Yes, this and all of our workshops are recorded. You can find them on the website under it's investing. I'll show you in just a second. Let me copy and paste this thing real quick. Let me do this one more time. Hey, there we go. All right, so CJ saw Mark Tepper on Fox Business News say that he expects unemployment to be at 7% in a year, and he based this on overlaying a chart of the National Home Builders Association sentiment with unemployment and then delaying the unemployment by 12 months. He said that this chart was an exact duplication. So this is that chart. I have a hard time seeing an exact duplication here. So I tried a couple of things here. Unemployment is in red, home builders are in blue. Yes, the first thing I tried was sorry. Okay. Yeah, the first thing I tried was just inverting the unemployment rate. Okay, so on this chart, unemployment goes up, the line goes up. On this chart, unemployment goes up, the line goes down. That gets you a little bit closer to being a mirror image. I still have a hard time seeing it as a mirror image. One thing that really stands out here is the sentiment is noisy. Right, it moves around a lot more than the unemployment rate does. So that's kind of interesting. All right, so here's the chart with no lag. So the lag essentially means that the home builder sentiment should be able to predict the unemployment rate in the future. You see that a little bit here and maybe here back in the 80s. Although in this case, sentiment bottomed, well, I guess it bottomed before, that makes sense. But then, right, we had this steady increase here and this big trough and peak and then back up that isn't reflected in unemployment at all. This shows up a little bit. Obviously, home builders got real worried about the economy before the rest of the world did in 2008. I think that makes sense. But it's also interesting that the sentiment shot up here. We had this sort of gradual recovery in unemployment. Right, so I watched the segment 3 or 4 times to make sure I was getting all of it right. And his thing was that there's, I guess, yeah, right. Some relatively large portion of the economy is in housing. And he was saying, especially if you include like all the things that go along with housing, like furniture and fixtures and things like that. Okay, so I tried to look at these charts, and again, right, like there's some basic shape things that sort of line up here, but I would have a hard time looking at this blue line and saying it predicts the red line. That doesn't seem right to me just looking at these. So here's the same series with no lag, just to line everything up, right? Like you can see the pandemic is in the same place here. Right, it turns out that home builder sentiment predicted the rise in, the rise in unemployment by more than 12 months. It's kind of interesting. So let's look at some other things. So here are single family home completions in red and home builder sentiment in blue. Sentiment is really just they do a survey of people who build, and this is important, single family homes, which are most of the housing in this country, but not all of it. So yeah, comparing sentiment to actual home completions, what's super interesting here is home completions are a lot less volatile than sentiment. Okay, sure, home takes a while to build. I might change my mind about how I'm feeling about things faster than I can work through whatever number of homes I have in my sort of construction pipeline. That's fine. But this is interesting because home builder sentiment recovered coming out of the Great Recession way faster and stayed high, and the rate of home building stayed relatively low. Right? I mean, this is the number of homes that were finished. This isn't like a rate or a percentage or anything. This is the number of homes that were finished. So it was just before the pandemic, or I guess just after the pandemic, where we've gotten close to lows from, the lows from the, early 90s recession, in terms of numbers of homes we were finishing. So sure, home builders felt great about the economy here and they feel less good about it here, but that didn't show up in the number of homes they were building, which I think is interesting. So let's look at single family completions, still in red, and total completions here in yellow. What you'll notice here is there's a gap that forms. This means that essentially the percentage, right, total completions is in yellow. Right, single family is in red. So more multifamily homes, right, more homes that are not single family homes are being completed than single family homes here. So that percentage of homes that is single family homes is smaller than it was. So look at the percentage of single family home completions and you'll see, you got to squint a little bit, but it never really recovered to some of the pre-financial crisis highs, even the, this is the percentage. So during the early 90s recession, a lot of multifamily stopped and people were building single family homes. There's also, people moving out of cities and some things like that. But we never, right, even the financial crisis run up, we got higher, but not super high. And we never really got back consistently above 75 after the financial crisis, when we had been above 70% of homes being single family before. All right, so here is the percent of single family housing starts. So it takes longer to build a, say, apartment building than it does to build a single house. So, and this is by unit, so it's not like one apartment building versus one house. It's, an apartment building that home counts for four here. But the number of single family dwellings is down significantly, right? Like this is a, multi-decade low here. And yes, sentiment is low, but it just wasn't ever really high, even when sentiment was high. And I think that's interesting. What this also tells me is the NAHB is a much smaller, right? They're accounting for a much smaller percentage of the economy than they were before, right? So you figure, okay, housing and associated services is, we'll take the guy's number, 20% of the economy. It's some amount of that is not housing because it's furniture and, stuff like that. But now we're down, what do you want to call that, 10, 15%? Of housing is not single family housing anymore. So that 20% housing, the pie is the pie is smaller, but it's also the piece of the pie that is single family housing that the NAHB people are worried about is much lower than it has been in the past. Also, housing is a strange market, right? I've talked for a while about how the housing market is kind of broken. But it's a strange market because essentially everybody is born short the housing market, right? If you think about it, everybody's going to have to buy a house at some point, right? So everybody is essentially short, right? Like a big spike in prices is bad for people. A big drop in prices is good for, not people who are looking to sell a home, but even if you're looking to sell a home, you're not looking to get out of the housing market. You're typically selling a home to buy a different home, right? And also the number of people not participating in the market is pretty small. The stock market gets crazy, people back out of it. There are lots of other markets where people are just like, yeah, I'm not doing that. Think about eggs, right? Eggs are super expensive. People eat less eggs. that doesn't really, the housing market doesn't really work like that. Housing is also not a commodity in the sense that nearly every unit is special in some way, or you can group units into certain blocks, but especially in single family, like when you consider all the variables like location and size, and some people have issues with stairs, things like that, it gets to be a pretty complicated market to try to figure out how it works from that way. And so there's a lot more matching a specific buyer with a specific seller than there is in other markets where things are pretty much, a car is a car. That's not 100% true, but it's more true than it is in housing. Certainly an egg is an egg. A chicken is a chicken. A hamburger is a hamburger. There's a lot less there. It's also very difficult to bring new supplies of housing online, right? It takes longer. There's zoning and there's other restrictions. We saw in the pandemic, people just couldn't get parts for houses they were trying to build, so that kept them from bringing new supplies online. So it's restricted in that way also. Another thing to think about in the housing market is there are lots of movement in the pandemic that pulled some activity forward, right? A lot of people relocated. There's a lot of remodeling and stuff like that. If I just moved 2 years ago, probably not moving real soon, right? So a lot of people moved all in a big clump. It probably slows down the rate of people relocating to some degree for a little while after that. A lot of people just remodeled and et cetera afterwards. If I just remodeled, probably less likely to be moving at that point. And also, because of the supply constraints and the higher rates, I've been saying the housing market has been broken for a long time. One thing that's interesting about this chart, if we go back to either the completions or the starts, is if you look at the steepness of this here, right, and think about the rate, and then look at this here, it's less steep here than it was here, which means we're just building homes slower, and where the rate of homes being built is also lower. And it didn't make it into the presentation because there's only so many housing charts I can show you. But population has grown, right? And it's growing at a rate that is closer to this rate than to this rate. And so we are underhoused in this country to some degree, which is why a lot of places home prices are so high. So all this is to say the housing market is real weird and broken in a bunch of kind of strange ways. And just sort of from first principles, I don't see where this chart or this chart is a mirror image. I see a lot of big moves historically in sentiment that aren't matched by a move in unemployment. And especially in a situation where single family housing is a smaller portion of the economy than it's been for decades. And, interest rates are kind of normalizing at this point. I wouldn't say, they're higher than they have been, don't get me wrong, but, I bought a house in 2008 with I think the interest rate was 6 1/8, and it was historically very low. And so, to be back, within 200 or 300 basis points of that on a 30-year fixed rate mortgage now, we're back closer to what normal interest rates have been. And so, yes, there will be an adjustment there. Yes, some home prices will probably fall in some places. And that certainly affects household wealth if you just think about like, oh, here are all my assets and what they're worth. But you need to have a house. And if the price of your house fell, the price of some replacement house has also probably fallen. So your real sort of net worth there is probably not changing as much as you think it is, because there's some liability created by the fact that you need a house. Yeah, anyway. All right, that is the only question we got ahead of time. I spent a lot of time on it. I like making charts, it turns out. But yeah, if anyone has any other questions, by all means, put them in the box. Yeah, let me show Richard real quick where to find those webinar recordings. If you go to the news section of the website, we'll post it in the featured section tomorrow when we get the video ready. And then if you go to personal finance, they show up here. There's one. Yeah, they have this Investors Observer Workshop on the image, so you can see. Here's a couple of them back here. It looks like there's one missing. I may have to push a button somewhere to get that to show up, but I'll worry about that later. So yeah, more questions if you have them. All right, so yeah, while I'm waiting to see if anybody has any more questions, yeah, this is recorded. It'll show up on the website tomorrow. Yeah, we'll send you an email when it shows up. The next one will be in 3 weeks. Yeah, we're working on some big stuff that we're pretty excited about. I don't have announcements yet because I'm not sure what's going to come out when exactly. But we do have some pretty exciting stuff on tap for 2023. So keep an eye on your email and the website, and also presentations like this, and I will tell you all about them as we get closer. So Van says, what is your opinion on the trend for Q2? What trend, I guess, is my first question. I mean, I'd also point out that we're a third of the way through Q1 at this point. So it's hard to really know. If you're just talking about the stock market, I think it could be kind of rough for a little while, just because I think it seems like people want the market to rally, and I think the Fed does not. And you know, it's a long-held saying in markets that you can't fight the Fed. I'm kind of interested to see how that turns out. I've seen several people saying that the Fed's going to be forced to cut rates, which I don't see any evidence of, and I feel like it's going to take a pretty rapid deterioration in a lot of places for that to actually happen. Jeff says, do you think oil is going to $100 a barrel this year? I mean, it's possible. I'd be maybe a little bit surprised. Just because, yeah, I feel like the frackers are going to come back online here in the US, and they're going to help shore up the supply. Certainly there's a chance of some other global shock happening, that could send oil up pretty quickly. But it's hard to predict exactly what that would be off the top of my head. I don't think it's impossible. I don't think it's super likely necessarily. But it's certainly within the realm of things that are possible. I don't think there's any structural reason why it would hit 100. I think it's going to take some sort of shock for that to happen. But unexpected things happen all the time. It's just, I've got a very long list of things that I'm not expecting, and the number of things that actually happen is kind of shorter than that. So it depends on which unexpected things happen that really determine whether or not that will happen. Oh, Van says, should we start buying Meta again for long-term investments? I mean, honestly, at this point, it depends on how well you think Mark Zuckerberg can transition into whatever the metaverse is. It seems like people wearing some kind of helmet and interacting with cartoon versions of each other. And I don't know if that's going to be supported by advertising or if that's going to be supported by just the sales of the helmet. I haven't really heard a coherent business model for the metaverse from Zuckerberg or anyone else, to be honest. So I don't know. I'm not. But yeah, at this point, right, like Zuckerberg controls the company. He's, the majority shareholder. You can't force him out. So yeah, it's a bet on whether or not Zuckerberg can make money on the metaverse or something else at this point. Don't know. Exactly. Yeah, I mean, from like a PE ratio point of view, 14 isn't terrible. The problem is they're not really growing anymore. So this PEG ratio has gotten high again. Granted, 2 isn't, 40 or whatever, like it was not that long ago, but a PEG ratio of 2 is still on the high side. And yeah, like I said, it really depends on how you feel about, Zuckerberg. I don't see a lot of growth from either Instagram or Facebook, and it seems like they're plowing a lot of resources into, again, whatever the metaverse is. So it's a bet on that. If in 5 years everybody's wearing helmets and interacting with cartoon versions of each other, and he's found a way to monetize that, it's probably real cheap right now. If he's going to churn through billions of dollars trying to make everybody sit in their living room and wear a helmet, I don't know how well that's going to work. All right. If you have questions between now and the next workshop, you can hit this help button and send them to us. We're happy to help, with things immediately. If you'd like to see something with charts and a little more thought put into it at one of these workshops, I'm happy to do that also. Richard asked, there's a video on using the platform, or if that's what these are for. So Richard, certainly if you have a question about a specific part of the platform or something like that, I'm happy to help you out here. We also have a bunch of videos about sort of what various parts of the site are and also how to use them. Here under, yes, if you go to Help Center and then how-to videos, they're all there. Also, if you just go to one of the other parts of the Help Center, you'll see anything that has this little icon next to it is a thing that has a video attached to it. Louise, yes, there will be a recording posted on the website tomorrow, and we'll also send you a link when it's up there, and you can find the other ones under the personal finance section of the website like this. All right, I don't see a lot more questions coming in, so I'm going to go ahead and start wrapping up. If you have a question, type faster. But yeah, thank you for coming. The next one will be in 3 weeks, which is, it looks like February the 22nd. So keep that on your calendar. We'll send you an email ahead of time. If you have questions anytime between now and then, you can hit the help button here. If you mention workshop, I'll put it in the workshop. Otherwise, I'll mostly get back to you the same day. Thank you for coming. Thank you for subscribing to Investors Observer, and I will talk to you again soon.